Something just happened inside the most important silver vault system on Earth that has never happened before in modern market history. In 7 trading days, 1 week, 33.45 million ounces of physical silver were pulled out of COMEX registered inventory for delivery, gone, physically removed, taken out of the system. That is 26% of the entire registered supply, withdrawn in 7 days. To understand how extreme that number is, the historical average for a January delivery month, which is not even a major delivery month on the COMEX calendar, runs between 1 and 5 million ounces. What just happened was 7 to 10 times larger than any prior January on record. And right now, at this exact moment, the paper silver market is open, trading normally, pricing silver as if nothing structural has changed. That gap between what the physical market just did and what the paper market is currently pricing is what this entire video is about. Because that gap has appeared before, and every single time it has, one of those two markets was catastrophically wrong. It was not the physical market. Here's what is happening right now inside COMEX and why every silver investor needs to understand these numbers before the March delivery cycle arrives. Total COMEX registered silver, meaning metal physically sitting in vaults with warrants attached, legally available for delivery against futures contracts, currently sits at approximately 82 to 88 million ounces, down from 532 million ounces in total inventory in October 2025, down more than 80% from the 2021 registered peak. But the January drain was not a slow bleed. It was a hemorrhage. On January 7th alone, a single trading session, JP Morgan issued 99% of 8.1 million ounces in delivery notices through 1,724 contracts. One institution, one day, 8.1 million ounces of physical silver moved. By February 11th, registered inventory crossed below 100 million ounces for the first time in years, with a single-day negative adjustment of 3.25 million ounces, bringing the total to 98.1 million. In the same 24 hours, another 4.7 million ounces were withdrawn from the eligible category, nearly 8 million ounces, one day. Now here is where the math becomes genuinely alarming. The March 2026 silver futures contract currently represents approximately 500 to 528 million ounces of notional silver exposure. That is 105,000 plus contracts at 5,000 ounces each, against a registered inventory of 82 to 88 million ounces. 6 times more paper silver has been promised than physical silver exists to deliver. If only 20% of March contract holders stand for delivery, a historically conservative number, the request totals 100 to 106 million ounces, against 82 to 88 million ounces available. The math does not close, not even close. The paper market is open right now, trading, pricing, as if that math does not exist. Now let me show you the signal that institutional precious metals traders watch every single morning, and that almost nobody in retail silver ever hears about, because this signal is the physical market's most honest voice. And right now it is screaming. Lease rates. When institutions need to borrow physical silver to meet delivery obligations, to cover positions, to secure metal they promised, they pay a rate to borrow it. Under normal market conditions with ample physical supply, the 1-month silver lease rate sits at approximately 0.3 to 0.5% annually. That has been the historical normal for 2 decades. In January 2026, the 1-month silver lease rate hit 8%. That is 16 to 26 times the historical normal. And during peak acute stress in late 2025, intraday silver lease rates spiked to 34.9%, with moments reaching 39.2% according to Japan Bullion Market Association data. More than 70 times normal, temporarily. Think about what an 8% lease rate means in the real world. It means institutions are so desperate to get physical silver in hand, right now, not eventually, right now, that they are willing to pay 8% annually just to borrow it. No rational market participant pays 8% to borrow an asset, unless the alternative, not having that asset, is more expensive than 8%. An 8% lease rate is not a data point. It is a distress signal in the exact language that institutions speak. And the paper market, the futures screen, the ETF prices, the LBMA benchmark, was not reflecting that distress signal in the price. That is not a small gap. That is the paper market and the physical market looking at the same commodity and arriving at 2 completely different conclusions about its availability. Now let me add the layer that should destroy whatever remaining confidence you have in the official silver supply numbers. Because the physical availability problem is not just about COMEX. It goes deeper. And the evidence is sitting in a published LBMA document that most people in this market have never read. On April 9th, 2021, to considerable fanfare, the London Bullion Market Association published updated monthly vault data for London-held silver. According to the report, silver in LBMA vaults had risen by 11% in a single month. from 34,896 tons to 38,859 tons, a jump of 3,863 tons. The LBMA announced it as a record. The press release was celebratory. 1 month later, quietly, they changed the number. The corrected figure showed actual end of March 2021 holdings of 35,557 tons, not 38,859 tons. The overstatement was 3,301.95 tons of silver. At 2021 prices, 106.16 million ounces, approximately $3 billion worth of silver the LBMA said was in London. Vaults simply was not there. The LBMA's explanation was a data submission error. One vault reported incorrectly. It was caught. Move along. Here's why that explanation is hard to accept at face value. The LBMA's own internal process, described in the document signed by their general counsel, who personally authored the correction, included a check where any submission considerably greater or less than prior submitted numbers triggered a reconfirmation request. An 11% single-month jump is by definition considerably greater. The system was supposed to catch this. It did not catch it for a full month. The correction was signed off by the LBMA general counsel, not a data manager. The organization's top legal officer personally modified the published vault record. And the timing. This phantom silver appeared during the Wall Street Bets silver squeeze of early 2021, the exact moment the London silver market was under acute stress. The LBMA's own published report acknowledged that concerns emerged as to whether there was enough silver in London during that period. The iShares SLV Trust actually changed its prospectus in February 2021, adding language that it might not always be able to acquire silver because physical availability was under pressure. $3 billion of phantom silver appearing on the books at the exact moment the physical market was being stress tested. The point is not to declare fraud. The point is that the official silver supply data, the numbers the entire paper pricing system is built on, has been provably wrong before, by 106 million ounces, published by the institution that sets the global benchmark price for silver during a period of physical market stress. When the data has been wrong before, when the institution publishing it profits from showing abundant supply, and when the physical market right now is simultaneously showing 8% lease rates and a 26% single-week drain, the question you should be asking is not whether to trust the paper price. The question is, what happens when enough market participants stop trusting it simultaneously? History has the answer to that question, and it is the most instructive parallel available right now. In 1979 and 1980, the Hunt brothers, Nelson and Herbert, accumulated nearly 200 million ounces of physical silver, 1/3 of the entire world's tradable supply. They did not just buy futures. They demanded delivery. Real bars, flown under armed guard on private planes to vaults in Switzerland. Silver moved from $6 an ounce to $49.45, a 7-13% move in 12 months. COMEX panicked. They introduced Silver Rule 7, overnight, without warning. It banned the purchase of silver futures on margin. Leverage, the fuel of the entire move, was eliminated by decree. The Federal Reserve told every major bank to stop lending to anyone in precious metals. The banks complied. Credit dried up. And on March 27, 1980, Silver Thursday, the price collapsed more than 50% in a single session. The exchange changed the rules. The crisis ended. Now here is why 2026 is structurally different from 1980 in the way that matters most to you right now. The Hunt brothers were the demand. Two men and their borrowed money were accumulating silver for financial gain. When COMEX changed the rules and removed the leverage, the demand disappeared because the demand was entirely manufactured by two men with a borrowed money position. Remove the leverage, remove the demand, end the squeeze. Today, the demand has nothing to do with two men or borrowed money. Industrial manufacturers right now need silver for solar panels, for electric vehicles, for AI data center connections, for medical imaging equipment, for 5G infrastructure. Industrial demand for silver has crossed 700 million ounces per year, 60% of total annual demand. That demand does not disappear when COMEX raises margin requirements. The solar factories in China and India do not stop running because a futures exchange got more expensive. The EV battery plants do not pause because lease rates spiked. You cannot regulate away the silver in a solar panel. You cannot margin call an industrial manufacturer. COMEX Rule 7 had no mechanism to stop industrial delivery demand. It still does not. And the supply side is equally structural in a way it was not in 1980. Global mine production has been flat for 5 years at approximately 830 million ounces per year. It has not responded meaningfully to higher prices because developing a new silver mine takes 10 to 15 years and the capital was not deployed when prices were depressed. The supply pipeline is limited regardless of what the paper market does over the next 12 months. The result is the 6th consecutive annual supply deficit. approaching 200 million ounces for 2026 alone. The cumulative deficit since 2021 has crossed 1.3 billion ounces. Those ounces were consumed by manufacturers, by technology, by medicine. They do not come back. And there is one more critical difference between 1980 and now. The tool that actually ended the Hunt brothers squeeze was not Silver Rule 7. It was Paul Volcker raising the federal funds rate to 20%. That annihilated the inflationary environment that had made hard assets attractive in the first place. The cost was a severe recession that crushed demand across the entire economy. Today, the Federal Reserve carries $36 trillion in federal debt. The Treasury pays $1.2 trillion annually in interest at current rates. A 20% rate today would make the entire federal debt structure mathematically impossible to service. The Volcker option does not exist. The single most effective tool used to break the 1980 silver squeeze is simply not available. COMEX can raise margins. They already have to $25,000 per contract. They can add trading limits. They can do exactly what they did in 1980 and more. But none of those tools address 700 million ounces of annual industrial demand that has no substitute and no futures contract to settle. The paper market can change its rules. The laws of physics that determine how much silver a solar panel requires cannot be changed. Now, let me speak directly to you. Because depending on how you are positioned right now, what you just learned is telling you something different. If you hold physical silver, actual metal in your possession, the data you just heard is the most significant validation of why you hold physical rather than paper. Every ounce you have in hand cannot be fractionally leveraged, cannot be hypothecated, cannot be the subject of a delivery dispute. It exists. The premium you paid over spot when you bought it, the premium was the cost of exactly the insurance, the COMEX drain, the lease rate spike, and the LBMA correction are now proving was worth every dollar. Physical silver dealers are currently charging $6 to $8 over spot. At current prices, the real-world cost of an ounce of silver entering your possession is running $94 to $96. The paper market prints one number, the physical market charges another. That gap is the physical market telling you what it actually thinks about availability. Right now, if you hold silver ETFs, particularly SLV, the LBMA 2021 episode is worth sitting with for a moment, not as a reason to panic. As a reminder that the silver backing your ETF is reported by institutions that profit from showing ample supply. The distinction between fully allocated silver, bars assigned specifically to your units, and unallocated silver, a general claim against a pool, matters far more in a delivery stress environment than in a normal market. Sprott PSLV operates on a fully allocated basis and has doubled its capital raise program to $2 billion specifically to acquire physical metal. That structural difference is worth understanding before a delivery stress event rather than during one. If you hold silver miners, the physical squeeze is a direct operating positive for your thesis, in a way that paper silver is not. Miners sell physical ounces at physical prices. When the physical price disconnects above the paper price, as dealer premiums already suggest it is, miners capture the physical price on every ounce they produce. Their operating leverage to a physical repricing is determined by the physical price, not the futures screen. If you are watching silver and have not yet decided how you want to be positioned, the data is not telling you what to do. It is telling you what you are looking at. You are looking at the most acute physical delivery stress in modern COMEX history developing against the backdrop of the deepest cumulative supply deficit in recorded silver market data. The specific mechanism and timing of how this resolves cannot be known in advance. What the data makes clear is that the current paper price is not reflecting the full picture of what the physical market is experiencing. Those two things have historically converged, not always on the timeline anyone expects, but the gap has never stayed open permanently. Now, the four signals, the ones that tell you how this is developing before any mainstream headline captures it. Signal 1, daily COMEX registered inventory. This is the most direct real-time signal available. Watch for two specific things. Sustained inflow days, metal being rewarranted, and added to registered, would signal the delivery stress is resolving as higher prices incentivize physical supply into the system. Continued drain days, particularly any single session exceeding 3 million ounces like the February 11th session, signal the stress is compounding rather than resolving. The direction of registered inventory in the 15 days ahead of March contract delivery is the clearest available leading indicator of what March actually looks like. Signal 2, silver lease rates. Normal is 0.3 to 0.5%. January 2026 hit 8%. Late 2025 intraday peaks reached 34 to 39%. The current lease rate level tells you what large institutions are willing to pay right now to secure physical metal. A rate above 3% means the physical market remains under genuine stress. A rate normalizing toward 1% or below is the first signal that physical availability is improving. This number is more honest than any COMEX press release. Most retail silver investors never check it. You now know it exists. Signal 3. EFP spread, the exchange for physical differential. This measures the premium between London spot silver and COMEX futures. In a functioning market, the spread is narrow and stable. During acute physical stress, it widens, reflecting the real cost of sourcing physical metal versus paper promises. The EFP spread widened to $1.10 per ounce during recent stress periods. When it narrows sustainably, paper and physical are reconnecting. When it widens further, the divergence is deepening. Watch the EFP before you watch the price. Signal 4. CME margin announcements. Silver margins are already at $25,000 per contract, raised from $20,000. During 2025 stress, the CME raised margins to 60% of contract value. Multiple margin increases in rapid succession. The 2011 playbook was 5 increases in 9 days, represent the exchange responding to delivery stress in real time. The price response to margin increases is historically sharp and often temporary. Understanding that mechanism lets you contextualize a violent price move rather than react emotionally to it. If you see multiple CME margin announcements on silver in a short window, that is not a sign the bull market is over. That is the exchange playing the only card it has left. 4 signals: daily registered inventory direction, lease rate level, EFP spread, CME margin announcements. Most silver investors check a price app once a day. You're now watching the 4 instruments institutional traders use to read the physical silver market before the price reflects what they see. Here is everything in one frame. 33.45 million ounces withdrawn from COMEX in 7 days, 7 to 10 times the historical January average. 26% of registered inventory gone in 1 week. Lease rates at 8%, 16 to 26 times normal, with intraday spikes reaching 70 times normal at the peak. 6 times more paper silver promised in the March contract than physical silver available for delivery. The LBMA, the institution that publishes the vault data the entire paper market relies on, was caught reporting 3,300 tons of silver that did not exist, corrected by their own general counsel during a prior physical stress event. The Volcker tool that ended the 1980 Hunt Brothers squeeze does not exist today. $36 trillion in debt makes 20% rates mathematically impossible. And 700 million ounces of annual industrial demand has no mechanism to be margin called, rule changed, or regulated away. The paper market is open right now, trading, pricing silver with 6 times more paper than physical behind it. The Hunt Brothers moved the price 700% with 200 million ounces in borrowed money. They were stopped because their demand was the only demand. Today, the demand is structural, permanent, industrial, and growing. The paper market says one thing. The vaults, the lease rates, the EFP spread, and the delivery notices say something else entirely. In every prior episode where those 2 markets diverged this significantly, one of them was wrong. It was not the physical market. Watch the 4 signals. The most important weeks in this story are directly ahead. The physical market will tell you what is coming before the paper price does. It always has. If you find these silver market breakdowns useful and want to support the research behind this channel, you can use the thanks button below the video. I appreciate everyone who supports the work. The paper market has 6 times more promises than it has silver. That math resolves one way or another. Watch the signals, not the screen.